What's going on, you guys? It's Lincoln here. Welcome to the video. Today I'm going to be making a follow-up on my Deep in the Money LEAPS video. If you guys missed that, you should definitely check it out. It's a pretty good video, and a lot of people have enjoyed what I had to say about it. It's kind of an unheard of, I don't want to say unheard of, but it's a strategy that not a lot of people talk about, and it is very useful, like I said. So check out that video. It's perfect for medium account size. By medium, I mean somewhere over $10,000 and up. You'll see a lot of professional money managers start to use them. If you watch CNBC at all, they talk about the options that they own. They all own calls, and they're basically all long-term, and a lot of the time they're deep in the money calls. So check out that video. This video will cover a lot of the same information, but this will get some different angles, some new angles. So you'll definitely want to watch both of them. So in my last video, I talked about Micron, and we kind of went over this profit and loss chart. A lot of people found it very helpful and useful, so I'm going to do the same thing, but today we're going to be looking at Apple. So if you guys don't know, and also notice $0 in Robinhood. So I'm using Robinhood just for the ease and the user interface and stuff. So I do have all my money in Fidelity, just like I told you. So I wanted you to notice that, and please follow my lead there. So here we are with Apple. Closed at $135.46, and we are going to look at their options. There's quite a bit of debate around how long-term a contract needs to be considered a LEAPS. Basically, in my mind, it's any contract that has an expiration date over 6 months into the future. So 6 months, 9 months, a year, 3 years, they're all LEAPS to me. So get that out of the way. And so here we are. In my example, I'm going to be talking about, and this is exactly what I do. I go over a year out. In this case, it's just under 2 years out, as it is towards the beginning of February. So here we are, the January 20, 2023 calls. This is an example of one that I would buy. I don't own any on Apple right now, basically because my account size doesn't really allow it. I like to be more diversified than that. Okay, so let's jump into my example. We're looking at Apple, and I'm going to be looking at the January 20, 2023 expiration date. So let's jump into that chain, and here we are. So you can see right here, the 135, this is the barely in the money leap that we see, break even of 20%. So Apple would need to increase in price in the next year and a half by 20% for this one to break even. So on this, we can see a delta of 0.60 and a theta of 0.01. So now let's look at a deep in the money leap, which is what I advocate buying for a variety of reasons. And I'll get into those in a second. So let's look at this $80 strike. You can see a delta of 0.89, which is right where I like it. I like it 0.85 and above. And you can see a theta that is very, very low, 0.0098. And then you can see here the break-even, 3.67%, and the break-even price right there. So let's jump into our profit and loss sheet. We're just going to focus on this point right now. I'll jump in, I'll break down the rest of it, kind of what I'm seeing, what I'm thinking. So here is kind of the specs that we just went over. So Apple is at 135.46 right now. We can see that, and $80 call is priced at 60.43. Okay, so we got all that. Break even is just the 80 plus the 60.43, 3.67%, and that is right there. Okay, so let's jump into it. So let's say January 20, 2023 rolls around, and Apple is still at exactly $135. So if you were to buy 100 shares of stock, you would be down just $46. And we can see $135.46. So that makes sense. So you're down about 1%. Whereas if you were to buy this deep in the money call, you would be down $543, and that is basically due to the fact that you paid premium for this contract. You can see that total premium is $497, which is the total dollar difference right there. So if you see this range here, I've highlighted it in gray. This is where you're worse off buying the LEAP as opposed to buying the shares outright. And by worse off, I mean your percentage loss is worse, and here is the total difference in your loss. So would you rather lose $46 or $543? Obviously, you're going to pick 46. Would you rather make $954 or $457? Obviously, $954. So that is the highlighted zone. You're quote-unquote worse off. I haven't brought into leverage or time value of money or anything like that. This is a very conservative profit and loss statement. I didn't want to overcomplicate it, but that is kind of the zone you're looking for. And then obviously, if it goes to $80 by January 2023, your call is going to be exactly worthless, and you're going to be at your max loss of $6,043, which is the total premium you paid, as opposed to $5,546 that you'd be down on your 100 shares. And you can see the percent returns right there. And again, the difference is just $497. If it goes below that, though, since you only paid $6,043 for the LEAP, that is your max loss. You can see right here, max loss. Everybody knows when you're debiting for options, your max loss is the premium that you pay. So you're actually better off in these bottom zones buying the LEAP because of that max loss. And then if you look up above, hopefully the stock that you're buying is going up. So this is kind of what we should be focused on, this range up here. Yes, you're still down $497 if you buy the LEAPS over buying the 100 shares for a dollar for dollar basis, but the return is much, much better because of the leverage you're buying. We're going to get into that in just a second, how that math actually works out. But this is the profit and loss chart. Yeah, so that's kind of the simple version, and I talked about that in the last video, so you can check that out there too. So now let's look into this section, and this is the part that I didn't talk about in my last video, and this is very, very important. So let's talk about the deltas. The delta on 100 shares is 100. So if you guys don't know what the delta is, it basically is the number that represents if Apple were to go up $1 per share, how much would your option move? So if Apple went up $1 per share on 100 shares, it would be up $100. Okay, so a delta. So the delta when you're buying shares is exactly 1 or 100. So hopefully that makes sense. And then the delta for our $80 strike is 0.8935. Okay, so that just signifies that if Apple were to go up $1, our call would increase by 0.8935. Okay, so if you had 100 shares of Apple and it went up $1, you'd be up $100. If you own this LEAP and Apple went up $1, you would be up $89.35. That is what it is showing. So the equivalent of 100 shares, obviously 100 shares, and another way to think about it is this is worth 89 shares. So same thing that I just said, if Apple were to go up $1 per share, our call would increase by $89. So that is just another way to think about delta, is to think about it in the equivalent number of shares. So the premium that we paid is that $4.97. Obviously there's no premium when you're buying shares. And here is the capital outlay. So if you were to buy 100 shares of Apple at $135.46, you're paying $13,546 versus our LEAP contract is just $6,043. Okay, so that is that. So now we have a price per share, obviously $135.46, whereas this you're getting 89 shares for a total cost of $6,043. So when we divide that out, you're getting each share for $67.90, and that is the critical thing. This is how you're leveraging your money with LEAPS. Okay, so you're paying a slight premium, but the amount you're paying per share is about 50%. Okay, and you're also your max loss, obviously just your total capital outlay for both of those. Your break even is a little bit higher because of the premium you pay for that extrinsic value. Okay, so this is a very critical factor. I mentioned it a little bit in my last video, but I didn't actually break it out. So let's say you wanted to buy, you were talking about spending $6,000, and you could either buy this LEAP or you could buy shares outright. Okay, so let's see how many shares you can get for $6,000. So we'll do 6,000, and we'll just directly compare it. So 6,043, and we're getting these for 135.46. Okay, there's no premium, so we can ignore that. How many shares are you getting? So we're just going to do equals 6,043 divided by this 135.46, and you are getting 45 shares. Ignore the dollar sign there. Okay. So you're getting the equivalent of 45 shares. So if you were to go out and spend $6,000 buying Apple stock, say you're committing, you're going to spend $6,000 on Apple. If you bought the shares outright for $135.46, you can get 45 of them. Or you could buy this LEAP and get the equivalent of 89 shares for the exact same cost basis. Okay, so you're doubling your exposure, which is the powerful thing. So you see these percentage gains, 414% versus 265. That is because your capital outlay is so much smaller and you're paying a lower price per share for the same amount of exposure. Okay, so that is the entire point of buying LEAPS right there. It is for that additional exposure for basically the reduced capital outlay. Okay, so they offer an incredible way to leverage your portfolio. Now, that said, I do not own an Apple LEAP. That is because I don't have $6,000 that I want to put into a single position. My entire account size is $33,000. So I don't want to commit whatever that percentage is, like 20% of my portfolio into an Apple LEAP, even though I think it would do fine. I might consider doing that in the future. I'd like to stay more diversified than that. Which brings me into another point. I didn't stress this enough in the last video. I guess 2 videos ago. Charlie Munger, he owns 3 positions. Okay, I'm not saying that you should own just 3 positions. I don't own 3 positions. I don't because I don't think I'm an incredible investor, and I don't trust myself to evaluate companies and basically come up with the 3 best ones that I want to commit all my money to. I'm much more conservative than that. I don't think I'm near as smart when I'm evaluating companies as Charlie Munger. Therefore, I'm going to stay more diversified, which he also recommends. He and Warren Buffett both are huge fans of holding index funds for common investors, and that's because common investors are not smarter than the average person. I don't think I'm smarter than the average investor, so therefore I stay well diversified. I sprinkle in some plays here and there. Part of it is for fun. I enjoy it. If somebody said, Lincoln, you need to make the most amount of money that you possibly can, there's a good chance that I would just buy an index fund, and I do not trust myself that much. I just enjoy the process, so I might be paying slightly for it. I might end up outpacing the market, but that point aside, stay diversified, okay? So that is why I do not own an Apple LEAP, even though I'd like to. If my portfolio was closer to $50,000, which it should be in the next couple of months, maybe you'll see me in this exact position. So why did I pick this $80 LEAP, for example? So one of them was because of the delta. Like I said, I like to have a delta over 85. That just keeps the theta super low. It's just a good target. Keeps the break even pretty low. That sort of thing. But this particular one, look at the open interest, look at the volume. Okay, so the volume obviously wasn't great yesterday, but this open interest basically means the bid-ask spread is going to be pretty narrow. Okay, so you want to pick these round numbers, which when they're deep in the money LEAPS, you basically only ever have round numbers. But if we compare the bid-ask spread, to the $75 strike. You can see about half the open interest, a little less than half the open interest, and the bid-ask spread is the exact same width. So you can find, let's look at this guy. If you looked at a company that wasn't as well traded as Apple, you can start to see wider bid-ask spreads in these deep in the money leaps. So be careful for those. I like picking them. I like picking leaps that have at least some volume every day and an open interest of at least 100. Okay, a bare minimum. There needs to be 100 other people in that option, because otherwise it is completely illiquid, and hopefully you can find options that have a little bit higher open interest than that even. So I guess it's a good segue into the other drawbacks. Obviously, if you're buying deep in the money leaps versus shares outright, you're not going to get a dividend, because the dividend goes to people who own shares, not people who own options on those shares. Okay, so that is something to think about. And if the contract expires out of the money, then it's worthless. Okay, so like we showed here, if the stock goes down to $50, at least you're still in Apple. Okay, you still have $5,000 in Apple if you bought the 100 shares, whereas if you bought the $80 call, you're completely out of it now. It expired out of the money. You have no position at all in Apple. I would argue, who cares? Because if Apple really drops by 90% in the next year and a half, do you want to own it anyway? Okay, so I don't really like that argument. And also, if you're buying deep in the money leaps, there's so little extrinsic value. It's basically all in intrinsic value, that it doesn't hurt you anyway. You don't really need to worry about expiring out of the money, because the max difference is just that premium that you paid, the break even. So let me explain this a little bit better. Say we were, instead of buying that deep in the money, say we were to buy this $125 strike for the same expiration date. Okay, we got a delta of 66. Obviously, the premium, the price of the option is much less. But let's look at the break-even difference. Okay, so this needs to increase by 16% for us to break even, whereas on our $80 call, we needed to go up by 3.67% to break even. Okay, so there is much more extrinsic value on this contract than ours. So theta is also much higher. It's over double what the theta is on ours. Okay, so this is why I always recommend buying deep in the money leaps. The only drawback to buying deep in the money leaps is because the outlay is much higher. So example, this is $3,200, whereas ours would cost us over $6,000. Okay, so that is the price you pay, but I think it more than makes up for it because of how much intrinsic versus extrinsic value makes up each of these contracts. Hopefully that makes sense. If you research this a little bit more, you'll find the same thing. And if you don't understand what I'm saying, probably shouldn't be trading these anyway. But hopefully it kind of piques your interest and sees what's out, so allows you to see what's out there, what different opportunities you have available to you. Okay? Okay, let's talk about why I look at using leaps as opposed to just buying weeklies or monthly options. And it comes down to the exact same thing I just talked about. It's all about the extrinsic value. So say we're going to buy a month out. Let's look at the exact same contract, okay? So $80 strike a month out. It is $5,543 to buy this. Or I can buy one over a year and a half out for $6,043, okay? So you're spending an additional $500 for another year and a half of time until expiration, okay? So you just stack the odds that much more in your favor, okay? So that is why you're buying these deep in the money, really long expiration options, is because it comes down to how much extrinsic value is baked into these options, and the further and further you go out towards expiration, the lower and lower amount of extrinsic value is there. That is good because the capital outlay is that much lower, relatively speaking, for the time that you are paying for, and theta is going to be much lower. Okay, So the theta on this is 0.011, whereas the theta on ours was like 0.009. And that is because theta can only eat extrinsic value. It cannot eat intrinsic value. Okay? So if we look at closer to in-the-money options, the theta is going to be that much higher because there's that much more extrinsic value that it can eat away at. Okay? So we went over the drawbacks. An additional benefit besides it just giving you a ton of leverage is the ability to trade calendar spreads. So if you guys saw my video about a poor man's covered call, I'll remake that video here pretty soon. So you can do those horizontal spreads, you can do vertical spreads, but instead of buying 100 shares, so say you wanted to sell a covered call on Apple, first you need to go out and spend $13,546, and then you could start selling covered calls against those. Or you could buy a deep in the money LEAPS, or any LEAPS for that matter. I prefer deep in the money because of the intrinsic extrinsic value ratio that we talked about. But you could spend $6,000 on one of those and start selling covered calls against that. So it is a much cheaper way. Obviously, poor man's covered call, that's where it gets its name. Obviously, buying deep in the money LEAPS isn't as low budget as buying one that's closer to the strike price. But that is what I recommend doing. That's what I do myself. I don't do this. I actually haven't done it since transferring into Fidelity because I'm still waiting to be approved to sell covered calls on my LEAPS, but I do own a few LEAPS in there. So let's transition over and talk about the positions I have. So you guys know the 3D Systems LEAP. That one is currently, I'll show some screenshots where these all are at, but you can see I own this January 21, 2022 call. I've owned that one for a few months, which is why I own the 2022 strike as opposed to 2023. And then Delta Airlines, Dropbox also. Those are both 2023, January 2023 calls. You can see all three of these are deep in the money calls. Just like I'm saying, Delta's over 85, close to 90 if I can. Yeah. The reason, like I said, the reason I don't own more of these is because of the lack of diversification in my portfolio. Once my account size grows, I will be adding more and more of these, but you can see all three of these are massive positions. The Dropbox one is pretty manageable, so if I find a few more companies that I have the same conviction level as Dropbox, then you might see a couple more of these showing up in my account in the near future. We can look at the rest of my portfolio right now while we're here. And here we are. So we're sitting at $33,000. You can see those LEAPS. Those have all done pretty well for me. Up a couple percent there. And 3D Systems. This is the second LEAP that I own on them. I sold the original one that was a $5 strike. You can see a $15 strike here. And here is the rest of the portfolio. So as you can see, based on Kathy Wood's recommendation, you can see CRISPR, and you can see Teladoc. Obviously, I'm just dipping my toes into those positions, but I think it can be an easy way to track those stocks, and like I said, just kind of get my feet wet there. Let's see my bigger positions over here by the weight. And there's the pie chart, which isn't super useful since I do own, what is it, like 33 positions or something like that? 35 positions. So I would like to dial this back a little bit, but there is the total portfolio. I hope you guys enjoyed the video. Please drop a comment down below if there's anything you want me to touch on. I went over this stuff fast. There's a lot of information here. I highly recommend checking out a couple other videos on these. There's getting to be more and more of them out there. But it is a very powerful strategy, especially for people in that kind of $20,000 and above range of the portfolio size. So do not put all your eggs in one basket unless you are as good of an investor as Charlie Munger. So thank you for watching. Like the video if you found the content useful, and subscribe if you want to see more like it. I'll catch you guys in the next video.